The numbers are in, and Canada's housing story has taken another wild turn. Home sales are slipping again, prices in some markets are quietly collapsing, and yet housing starts are suddenly surging. Vancouver just rezoned thousands of lots overnight, but will anybody actually end up building on them? Meanwhile, mortgage debt has hit an all-time high. Nearly 8 out of every $10 Canadians own is now tied to housing. And inflation just spiked when everybody thought it was under control. So where does that leave us heading into the final stretch of 2025? Will falling affordability finally force the next rate cut, or will the Bank of Canada hold the line, probably freezing the market even further? We're breaking it all down from record level mortgage exposure to the cities where prices have quietly crashed 40%. This is an episode you don't want to miss. Now, just before we get into all of this week's real estate news, we have an exciting milestone to share with you. This is episode number 300 of the Vancouver Life Real Estate Podcast. The channel was launched on June 22nd in 2020, and we are proud to announce that we have released an episode every single Saturday without missing a single week. The channel has grown to over 7,000 subscribers and receives over 70,000 views every month. We are incredibly grateful for all your support over the years. So if this is your first viewing or your 300th, thank you from the bottom of our hearts. And as a thank you, we want to give away one of our most sought after resources. We've created a manual for home sellers that it outlines all the strategies we use to ensure that the homes sell for the highest amount possible. Now, typically we reserve this for our clients only. It covers the best practices to prep your home, including the pre-inspection, improving curb appeal, and organizational tips to get your home showing in its best light. It even includes a 100-point checklist of which areas to focus on and which ones you're okay to leave out. If you would like a copy of this valuable guide, just type top dollar in the comments below and we will provide you with a link to it. Now, let's get into today's important real estate news. The CREA, Canadian Real Estate Association's data is out and all the new numbers are in. So let's give you the top line information. Sales volumes declined by 1.7% month over month, and it ended a string of gains that began back in April. That said, it was the best month of September sales dating back to 2021. Bit of a stretch there, but they're trying to make it sound positive. Year over year sales were up just over 5%. Listings, on the other hand, they were down about 0.8% month over month. Total active listings across the country lowered as well by the same amount, 0.8%, meaning there ended up being 199,772 homes available for sale across Canada at the end of last month. The ratio resulted in 4.4 months of inventory, and it's the lowest actually it's been dating back to January. And it is below the long-term average of 5 months. HPI, when we look at prices now, it dropped a little bit, 0.1% month over month. And when we look from where we were a year ago, prices are down 3.4% across the country. Average prices, on the other hand, were actually up about 0.7% year over year. So nationally, BC and Ontario remain the only provinces which are seeing downward pressure on home prices year over year, with every other province posting gains. The Yukon achieved the highest annual price increase year over year, up 13.4%. But let's dig a little deeper. We're sharing a chart that shows the change in Canadian home prices since the February 2022 peak, shown in both nominal and inflation adjusted dollars. As you can see, Hamilton has taken the biggest hit to the downside, followed by GTA and then Canada as a whole. Vancouver sits in third spot, or fourth if you include national. Real home prices in Canada are now down 29% since the peak, or 18% in nominal dollars. The largest increases since February 2022 are the Greater Moncton area and Saskatoon, hitting an additional 19% higher nominal prices and around 8% higher when we look at the inflation adjusted numbers. RD, Vancouver, Greater Vancouver, is down 20% in real dollars since that peak. And the hardest hit is the area of Hamilton, which is down 40% in inflation adjusted dollars. A key indicator here to watch is the increasing gap that we are seeing between new listings and sales. This metric continues to widen and is a strong projector as to future values. This metric points to, pretty obviously, continuing downward pressure on prices. Now, when it comes to affordability, it has improved off the unaffordable peak that we realized in 2024. But, when we look here in Vancouver, monthly mortgage payment on median home prices as a percentage of median income sits at 87%. So it's completely unrealistic and remains widely out of reach for the majority of would-be home buyers.
All right, let's have a look now at what's going on with prices in the US. Canada is not alone in home price shifts unique to geographic location. We're displaying a chart here showing home price changes in America's 50 largest metro areas. The month-over-month figure is between August and September of 2025, and the year-over-year figure is between September 2024 and September 2025. And the shift since the 2022 peak is the change in home prices since each market's respective 2022 peak. It's not always the same date, apparently. But a number of things actually stand out. The month-over-month figures do not look very encouraging. The vast majority of markets have gone negative. Of course, 1 month does not make a trend. The year-over-year column, which is how this table is sorted, looks more balanced, but the national average is still at 0%. The most prominent outliers in the negative direction are New Orleans, which has been uniquely flat since the start of the pandemic in March of 2020. San Francisco and Phoenix, which have both seen double-digit percentage drops since the peak, and Austin, which is down over 25% since the peak. Austin is also a prime example of what happens when you bring a lot of new housing supply to a market. The prices come down. Even with declines since 2022, most markets remain up significantly, with many smaller markets like Buffalo and Hartford continuing to show strong year-over-year gains. It is interesting that over 5 years later, we are still working through the market distortions brought about by the pandemic. The market is still very much clearly looking for its new equilibrium.
So now that we've got an understanding of what current prices are doing, let's have a look at what's happening with future home stock to get an idea of where that might drive prices as well. So rezoning has been in the headlines a lot lately, right? Especially with Burnaby scaling back its bylaws and its ability to be able to bring more homes to market. But other areas are still trying. So check this out. Vancouver just made one of the biggest moves we've seen in years to accelerate new housing. City Council has approved a sweeping rezoning across the Broadway plan and the Cambie corridor, impacting roughly 4,300 properties. And this is in an effort to fast-track development and cut through years of red tape. Keep hearing this a lot. Now, what makes this so significant is that the city itself initiated the process. See, normally rezoning happens project by project, one developer at a time. But this time, Vancouver took the lead, essentially pre-zoning these areas to allow for new low-rise, mid-rise, and high-rise developments right away. The goal? Well, it's to make building homes faster, simpler, and more predictable. Projects that fit within the new framework will be able to skip the traditional rezoning process entirely and move straight to a development permit application, shaving off upwards of 12 months within that approval timeline. Good news. Mayor Ken Sim called it, quote, a major step forward in delivering the homes Vancouverites need faster. And he's not wrong, right? These changes are designed to align with the Vancouver plan, the Broadway plan, and the Cambie Corridor plan, while also fulfilling commitments tied to the Federal Housing Accelerator Fund and BC's transit-oriented development legislation. So under these new rules, the new buildings will need to include a mix of housing types, from social and below market rentals to secured purpose-built rental units. In high-rise zones, for example, 100% of the new homes must be rentals, with at least 20% being at below market rental rates. Tenants that are displaced by redevelopment will remain protected under the city's tenant relocation and protection policy, ensuring that they can return to new buildings at similar rents. Of course, they have to wait 3-4 years for those to be built. Who knows how many will come back, but that protection is in place. So here's what the new rezoning looks like on the ground. Low-rise zones that are zoned R3 can build up to 4 to 8 stories. Mid-rise in R4 zonings can go around 12 stories. And the high-rise zones, R5s, are up roughly to 22 stories. Most of the changes are centered around future SkyTrain stations and along the Broadway extension and near the Oak Ridge 41st area along the Canada line. Areas that the city says will become more connected, more affordable, and more transit-oriented. So, in short, Vancouver is trying to kind of reset the zoning game. Instead of waiting years for individual rezonings, the city is laying the groundwork for housing to happen now. But of course, this becomes and brings us to the real question. Will developers actually build on these new rezoned lots? Or will the high costs of obviously development and city fees and market uncertainty keep the cranes out of the skyline? Because you got to think, on top of this, there are currently a record number of purpose-built rentals under construction, and they're rezoning for more rental construction. And at the end of the day, that's a good thing. But again, they're kind of doing this at a time when the developer desire to build that type of property, I think, is very low. And so I think it's going to take some time to see any kind of absorption in these new zone lots from developers to really start to consider building them.
You know, Dan, it's as if I feel politicians tied their successful outcomes to affordability, which in my mind is a bit of a mistake, because there's not much that they can actually do with that. That's far more of a central banking thing. They should have tied it to more supply. Had they done that, I think they'd be looking a lot better. But attaching it to affordability is a very difficult thing to do, I think, as many politicians are finding out. And though, with that said, let's have a look at housing starts, because there's some decent news here. Canadian housing starts increased 14% from the previous month, totaling 279,234 units as of September. Starts were up 25% from the same month last year. And in British Columbia, though, starts fell by 20% last month to just 37,305 units. In areas of the province with 10,000 or more residents, single detached starts decreased by 5% to 3,965 units, while multifamily starts fell by 23% to 30,197 units month over month. Starts in the province were 15% below the levels September of last year, and year-to-date starts are up a whopping 101% in Abbotsford. Though, reminder that the vast majority of these starts are, like Dan mentioned, purpose-built rentals. Now, speaking of rentals, let's look at the rental rates too. The latest live.rent report shows an increase in rental rates for one-bed units in Vancouver, increasing not a lot, but $52 a month, month over month, to $2,223. That actually forms a 3-month high. Rentals.ca reports Vancouver rents are down overall by about 7.8% year over year, call it 8%. Every province other than Saskatchewan and Manitoba have rental rates lower year over year.
Looking at mortgages now, Canada has just hit a new record, and it's not the kind that you want to celebrate. According to the latest data from StatsCan, mortgages now make up nearly 8 out of every $10 of household debt. That is the highest share we have ever seen. And it shows just how deeply tied our economy has become to real estate. Total household debt in Canada now sits over 3.1 trillion, up nearly 5% from this time last year. But here's the real story. Almost all of that growth is coming from mortgages. Mortgage balances alone rose 11.5 billion in August, reaching 2.33 trillion, which is roughly 74.5% of all household credit. And that's a 7.5% jump in just a decade. And it wasn't even this high during Canada's last big credit cycle, which took place back in the 1990s. So what does this mean? Essentially, Canadians are more leveraged to housing than ever before. And that concentration, it's becoming quite risky. Unlike credit cards or car loans, mortgages aren't flexible debt, right? You can't just cut back when the economy slows down. So that makes households, and by extension, the entire economy, more vulnerable to rate shocks or a housing correction. It also distorts how monetary policy kind of works here. When so much of the country's debt is tied to housing, every rate move made by the Bank of Canada hits homeowners harder, amplifying the ups and downs of the housing market and complicating inflation control. And of course, even the Bank of Canada has acknowledged this. A deputy governor recently admitted that Canada's inflation numbers are being skewed by how mortgage interest costs are factored in. something most other countries, they don't even include that in their basket. So adjusting that might help policymakers get a clear picture of quote unquote true inflation, but it also means the housing market could face less cushion from future rate cuts. The bottom line is this: Canada's economy has become almost entirely housing driven, with nearly 75% of all household debt now tied to mortgages. Even small changes in interest rates ripple through everything, from consumer spending to economic growth. So while some are waiting for lower rates to rescue the housing market, this data makes one thing clear: the country's financial health is now inseparable from its housing market. The Bank of Canada is on deck next Wednesday for their next rate announcement. And at the very end of this video, we're going to share the current market odds of a potential rate cut or not.
Isn't that so silly when you literally consider the kind of country Canada is, with the vast amount of resources that we have, manufacturing capacity that we have, two coasts to export these materials to, the biggest economy down south. I mean, to me, it seems so silly that, we have so much housing tied to our economy. It just seems ridiculous. With that said, let's move to inflation here, because Canada's latest inflation numbers came in hotter than expected. They've definitely thrown a curveball into the decision-making process for the Bank of Canada. According to StatsCan, consumer prices rose 2.4% year over year in September, up from 1.9% in August. Economists have been calling for about a 2.2% jump, so this was a bit of a genuine surprise, especially after months of cooling data. Now, the key driver here wasn't broad-based inflation. It was mostly gasoline prices. They dropped 4.1% from a year ago, which sounds good, but that's actually a much smaller decline than August's 12.7% drop. Combine that with refinery disruptions and rebound in oil prices, and you've got higher prices at the pumps pushing up the overall CPI basket. Even when you strip out gas out of the equation, inflation ran at 2.6%. While the Bank of Canada's core measures, CPI trim and median, held steady at around 3.1 and 3.2% respectively. So while inflation doesn't appear to be exploding like we've reported on before, it's certainly stickier than the Bank of Canada would like to see. When I break it down a little further, rent climbed by 4.8% nationwide, led by nearly a 10% growth in Quebec. Grocery prices jumped 4%, the fastest pace we've seen since 2023. And here in BC, prices rose by 1.9% year over year, which is a small uptick from August. So what's the takeaway? Well, inflation is still appearing to ease overall, but it's not linear. And that complicates the Bank of Canada's next move, at least temporarily. Markets were almost certain we'd see another quarter point rate cut on October 29th. But after this set of data, the odds slipped from 77% down to 69%. While most economists still think a cut is coming, it just might not be in October. CIBC says core inflation is subdued enough to support another rate drop, while BMO is calling the data annoyingly sticky. TD likely summed it up best by saying one hotter month doesn't make a new trend. So what does this mean for you? It means rate relief is still coming, but maybe not as fast as you had hoped. The bank is watching the data closely, and if that inflation around that 2.5% mark with the economy continues to cool, that next rate cut might still be on the table before the year end. One other thing, Dan, that I do want to mention when it comes to inflation, and while we have had, national measures to reduce the inflation, if you look at the global M2 money supply and you see how high that is, inflation, in my mind, is just we're deferring the problem. And in many ways, it's going to come back stronger than it has before, just, I think, years in advance. Because no matter what you do, if you continue to print obscene amounts of money, inflation just will show up, whether it's now or later.
And what a difference a day makes, and what a bigger difference 2 days make. The percent of rate cut estimates that Ryan shared was shortly after the CPI print came in, and 2 days later, it's moved again, of course. And right now, market odds are showing a 43% chance of a hold and a 57% chance of a cut. and 0% chance of an increase. So it's almost, we're almost split down the middle at this point. A lot can happen, obviously, between now and next Wednesday. We will see. But at this point, it looks to be anybody's guess whether it's going to be a hold or a cut. That is it for episode 300. Thank you so much for tuning in and watching. We always appreciate it and truly appreciate the support for everyone who's watched one or more of these videos. Have a wonderful weekend, and we look forward to seeing you back here next week.